So anybody who's been following my website over the years, you know that I'm a huge fan of trading iron condors. I think they're one of the most versatile and effective option spreads out there, which is why my iron condor fund makes up 25% of my total portfolio. I consider option trading to be an asset class of its own and a great way to add diversification to any portfolio. But for many people out there, there's still this knowledge barrier to option trading where they feel they just don't understand it well enough to participate. So I'm going to continue to try to tear that down and make it accessible for everybody, no matter what your experience level is. My Iron Condor fund currently has a live trade open right now, so we're going to take a look at that one and see what we can learn. So here we are inside the Thinkorswim platform, and of course, full disclosure, I always execute my trades with interactive brokers because their fees are a little bit cheaper, but this platform is so much nicer to look at, so it is my go-to YouTube video software. We can see the markets are down a little bit today. This is the Russell 2000, and we're down over 1% right now, so they're sliding a little bit right now. And just as a side note, the VIX futures term structure actually went backwards today. You can see the front 2 months here. We're down about 0.36%, so it just ticked negative, and this actually hasn't happened in quite a while. If we go to my spreadsheet really quick, I've got a column here, M1, M2 is backwards. We can go all the way back here to this date, which is November 4th of 2016. So it's been a while, and we'll see how long this lasts. But today I want to talk about the basic anatomy of an iron condor, and for that I'm going to use the live trade that we opened in the VTS Iron Condor strategy last Monday. So the trade we opened 7 days ago. It looks like this. This is all the information. We did the Russell 2000, a May expiry. These are all the strike prices, and then the premium we pulled in was $2.30. So that's the trade right here. This is what it looks like. This is your basic iron condor. You've got the shape that always looks like this. These edges here are the break-even prices. Now remember, those are break-even prices at the expiry date, which is all the way out in May. We never let our trades run very long, so we're certainly not going to pay attention to those. But the first question people might have is, why are we opening this trade at all, right? What is the advantage of an iron condor? So the vast majority of traders are just used to owning stocks, or ETFs, mutual funds, and of course bonds, gold, oil, real estate REITs maybe, whatever it is. But in general, if it goes up in price, you make money, and if it goes down, you lose money. Of course, the opposite is true if you're short, but most people and most fund managers out there are just long-only traders, basically buy and hold investors. The reason the iron condor is so powerful, and it just in my opinion, that at least some portion of your retirement fund should be allocated to this type of strategy, the reason is because this trade profits when nothing happens, when prices go nowhere. And this actually happens quite often in the markets, especially on a 1-month time frame. Quite often the markets do just chop around sideways and they don't really make any headway in either direction. Most people don't have any exposure to this though. They make or lose money only when the markets do something significant. And of course in the right direction that matches their profit goals. If you're long stocks, it's not good enough to just have stocks move. They have to actually move in the direction you want them to. So in my opinion, it's a good idea to have a portion of your funds that can actually turn a profit like the iron condor can when your other holdings are maybe not doing anything. So that's the why we trade them. But now let's get into more specifics on how you can actually interpret this trade that you have open. Of course, I'm going to be giving the signals every month, both when to open them and when to close them, so you don't actually have to know any of this stuff to follow the strategy. But if you are interested in some basics, you can do the following. So the first thing that I do is I put up these little hash lines right on those break-even prices. So this pink line you can see, this is the daily profit loss line, and this will be bouncing around because of course the markets are live right now. So the prices are going to be changing a little bit. But I always put these little hash marks right on the break-even points. This will just give you a very quick snapshot of whether your trade is currently profitable or maybe it's outside of the profit range. So this little gray hash line, I'm sure your software shows something quite similar, but this little gray hash line is today's price. And you can see we are inside the hash lines, so we're currently profitable. We can hover the mouse right over this hash line, and we're currently up $211. The next thing you can do is add a couple more hash lines on the stop loss points. So for our trade that we opened, I just labeled the stop losses. These are mostly mental stop losses. I will be telling people when to actually close the trades, but our mental stop loss is $3.45. So if we opened our trade for $2.30, that's the premium that we pulled in, our stop loss is $3.45 for a difference of $1.15. In this trade example, we have 4 contracts open, so 4 contracts times $1.15 per is actually $460. That's our stop loss, and it also happens to be our stop gain. So what I do, your software might be slightly different, but in Thinkorswim, just add the little plus sign, and this is going to add a couple hash marks. I go ahead and find that $460 line, or thereabouts, somewhere around there. I'll add another one for the stop loss over on this side of the trade, find that 460, and I just basically leave those there. So now not only can we see the break-even points, but now we can also see when we're going to think about closing this trade out. And of course, the stop gain of $460, we can just hover on today's price. When that hits somewhere around 460, we'll definitely be looking to close this trade out. And that's it. As far as day-to-day tracking, that's all you really need to know. You can just watch it develop, you can see where we're at in the current cycle, and you can see when we're getting ready to close the trade out, hopefully for profit, but you can see the stop losses as well. Now, for people who are looking to dig a little bit deeper, let me just briefly go over what's called the option Greeks. So I do have the article on my website here that goes over the option Greeks. You can read this one if you like. There's an iron condor trade in there. This was all the way back in 2013, and then it talks about delta, theta, all of the Greek symbols. There's actually quite a few of them. There's some that people aren't aware of, so if you really want to go into detail, you can check out this article. But a visual representation is probably easier to follow, so I'm going to go through them all here really quickly. So the first Greek is called delta. Now you can see that the picture changed here. I'm going to hover over today's hash mark, and it says $6.59. Delta says that if all things are held constant, if the Russell 2000 index goes up by $1, our option trade will actually lose $6.74 in value. If it goes down by $1, we'll gain the $6.74. So I'm going to move down this line. You can see the further away we get from today's price, we're losing more and more money according to the delta. Now that makes sense because when we look at the actual trade, the further away we move from the price, we are going to be losing money. The next Greek is called gamma. You can see right now it's a very small number. It just says 37 cents. This is because there's actually a long time to go in this contract. We still have 45 days to go until expiry, so gamma is going to be very small. But what gamma means is every dollar that the Russell 2000 is going to be moving, this is how much the delta is going to change. So delta will change 37 cents if the Russell 2000 moves by $1. If we go back to the delta, I know this is a little bit confusing. Gamma is actually the hardest one to understand. But you can see it says $6.76. And then if you tick up a little bit, it's all the way up to $7.55. It goes to $8.50. That's basically what gamma is telling us, is that the more and more it ticks up, the more it's going to change that delta value. We don't really pay attention to gamma for a little while. We like to close our trades out early. For those people who do hold iron condors very close to expiration, gamma becomes a very important Greek. But for us in the beginning with 50 or 60 days to go, and we still have 45 days, gamma is really a non-issue. So the next Greek, an important one, is called theta. What theta tells us, if I hover over the current price, it says $21.79. What this is telling us is that all things being equal, the passage of one day will profit $21.79. So theta is essentially why iron condors are profiting from day to day, because every day that the price stays in this sort of general range here, we're going to be making that much money every single day. So tomorrow, if the price opens exactly where it is today and the volatility is the same and everything's more or less the same, we will have made almost $22 for doing nothing. The Russell 2000 stayed exactly where it was, but we actually made some money. This is why iron condors are going to be able to profit from that non-market action that most of your other holdings in your portfolio are just going to be zeroed. So this is why we trade iron condors. It's because we're trying to capture that theta. And the final Greek that you want to look at is Vega. Now for iron condors specifically, Vega is also a very important Greek. When I hover over today's price, you can see it says minus $132. Now that's a much bigger number than all of the other Greeks. What Vega means, if the volatility on the Russell 2000 goes up by 1%, we will actually lose $132 on this trade. So iron condors are quite sensitive to Vega, quite sensitive to those volatility changes. But on the flip side, If the volatility on the Russell 2000 goes down by 1%, we will make $132. So this is why iron condors are considered short volatility trades, because we actually want volatility to decrease while we're holding these trades. One of the most common questions I get asked, because we actually remained in cash for the last 3 months, a lot of people ask me, well, why are you in cash? The markets aren't moving anywhere. Isn't that great for iron condors? And my answer is, well, yes, you definitely want your price to stay in this range. So low volatility environments are seemingly good for that. Actually, it's that Vega number that we want to be concerned about, because if we do open an iron condor when volatility is very low, volatility really has nowhere else to go but up, and every 1% uptick is actually going to cost us quite a bit of money. So you definitely don't want to be opening iron condor trades during low volatility environments. You don't want to be opening any volatility trades, at least on the short side, during those low volatility environments, because that little uptick in volatility is going to be extremely expensive. And the theta, which is helping us, is not going to be able to compensate for it. The delta is also not going to be able to compensate for it. It's only a $6.60 delta right now. So it's that Vega that we really do have to manage. So those are the main Greeks to get you started. Just those 4 are really the only important ones you need to look at. As you get some practice, seeing how they all interact with each other, coupled with just the basic hash lines that I showed you, as well as the stop losses, you're going to be able to monitor your trades as they go. Like I said, hopefully this little hash mark here hits that $460 before the price hits either this line or this line over here. So option trading is definitely a lot of fun, not only because you can always have something to do and something to monitor, but also because you can design trades any way you want. This iron condor here is market neutral, where you just want the price to kind of hang out in this range here, but you can build options to do anything. You can mirror a long stock position, you can go short, you can set them up to have different ratios, so if stocks go up, maybe you'll make half as much money or twice as much money. You can mix up the monthly expiries and you can play a short April against a long May. The possibilities are endless. And of course, you're not just limited to stocks. You can option trade on bonds, on gold, on oil prices, whatever you want. So if iron condors are still new to you, maybe you don't understand everything just yet, and that's fine. If it was easy, of course, everybody would be doing it. But hang in there. Try to get into those monthly trades that we're taking. You can watch them develop over time, apply some of those fundamentals that we just learned, and in the long run, I promise you your retirement fund will be better off for it. See you next time. So if you click the link right here, sign up for the VTS newsletter, you're going to get complete access to all of our trading strategies for a full 2 weeks absolutely free. And if you're new here and you like this video, please consider subscribing to my channel. You can do that down below. Hit the like button, and of course leave a comment. I'd love to hear from you. See you next time.